Welcome to our second teaching. This is King Helks, and in this video we're going to be going over the second part in our introduction to forex trading teaching, and we're going to be treating how to get started. So in this video we're going to be going over what is a broker, platforms and charting software, and understanding forex orders. So let's get right into it. So first of all, what's a broker? So a broker is a financial intermediary that matches counterparties to a transaction without being a party to it. What this means is that counterparties, which means there are two parties, right? So you are one party over here. The banks where you buy and sell the currencies from, they are the other party. Then the broker is in the middle. So the broker is basically or essentially the middleman, right? So you don't have to go to the bank to buy the currency or sell the currency. Your broker interlinks you guys and allows you to buy and sell from a platform, and that platform being MetaTrader 4, MetaTrader 5, or any of the new and upcoming platforms. So in Forex, a broker is an agent or company that executes orders to buy and sell currencies for their clients. In this case, you are the client. They act as intermediaries between banks, bringing buyers and sellers together for a commission paid by the initiator by both parties. So essentially, if you were selling and buying currencies physically, you'd have to look for a buyer, right? You'd have to look for a seller if you were selling, or you'd have to go to the bank. So in this case, like the essence of a broker is to be that middle party that interlinks you to that buyer or to that seller via the banks, via the hedge funds, and all of that. It's all stuff that we don't need to get into. Brokers are agents working on commission and not principals acting on their own account, right? Earlier on when we talked about spread in the previous video, we said how the difference between bid and ask, that's spread, right? Instead of them offering you to buy or sell at the present market price, they'll push it either up or down. So that little difference is what they make, right? So so brokers, they get commission either by spread or from other ECN accounts kind of stuff. So I'm not going to dive too deep into that right now. Some good brokers I'd recommend are XNS and Kwaku. So I've used XNS for the longest time since I started. I've funded my live accounts with it, and why for proprietary trading, right? I've used Kwaku. So XNS and Kwaku are good brokers that I'd recommend. So this is what I was explaining earlier. You're over here, you're the trader. This is the banks, right? The big banks, the hedge funds, the mutual funds, where buyers and sellers all are. So this broker links you to these banks. So it interlinks you guys. It allows you to buy and sell over here, right? So this is just an illustration to explain what I said earlier in the previous slide. So going further, so this is XNS, right? This is their website. This is where you come up and then you either register, right, or sign in if you already have an account, and then they will show you the different type of accounts that they have, right? So you can go and check you can go check out this broker or other brokers and understand what it's all about, right? So when you see minimum deposit, that's the minimum you can deposit, spread, commission. So when you see commission, what commission actually means is that instead of them like giving you too big of a difference between ask and bid, right? So there will be no spread, and then they'll be charging you like $1, $2 per every trade you open. So you can decide if you want a commission account or you want a spread account, right? But if you are not trading a very huge account, you should go for the spread, because commission, if you're trading like let's say a $10 account and you choose commission, the commission can wipe out your entire profit. So leverage, we talked about leverage earlier, so you can choose a very high leverage using XNS, which I wouldn't recommend. So instruments, earlier on in the previous video I talked about how you can trade different things. You can trade currencies, which is Forex, so metals, you can trade cryptocurrencies, you can trade energies, you can trade stocks or equity, you can trade indices. So don't get too overwhelmed with all these new terminologies and everything. there are some certain things that you need to know and other things that you don't need to know. So if you still don't understand the concept behind leverage or spread or anything, you can check out articles online. You can check out babypips.com. You can check out educational materials on YouTube to understand them further. So let's keep going. So basically these are the kind of things you see when you're trying to choose an account on a broker platform, right? So this one talks about the minimum lot size you can open, and if you remember 0.01, that is basically a micro lot. Shows you the maximum lot size you can open, the maximum number of positions, blah blah blah. So all of these are factors you have to consider when you are opening a forex trading account, right? So when you choose a broker, right, they will give you a login and password. Now that login and password they give you is for your trading platform, either MetaTrader 4, MetaTrader 5, right, which are the most used, right? So but when you want to analyze, right, let's say you have gotten your login and everything from your broker and you have put it on MetaTrader. When you want to analyze whether the market is going to go up or is going to go down, you come to tradingview.com, or you get the TradingView app on your phone. And so this is where you analyze on TradingView, right? You can see all these tools here for analyzing. You can choose the different assets. You can choose either you want to analyze Forex, you want to analyze whatever it is, right? While over here are different tools again. You can still go and check other YouTube videos or educational materials on how to use TradingView and MetaTrader. So you analyze here, and then you execute or open positions here. So now when you want to open positions on MetaTrader, there's something called orders, which is what we're going into next, right? Because when you want to say, okay, I want to sell this particular currency, I want to buy this kind of currency, this particular currency, and you come to this place on your MetaTrader, when you click here, it will show you instant execution. It will show you a bunch of other options, right? So that's what I'm going to go into right now to explain. So understanding Forex orders. An order is an offer sent using your broker's trading platform to open or close a transaction. So when you want to sell, I'll always use the example of Euro USD because it's what I trade. I trade Euro USD and GBP USD, and it's what I'll be using for our upcoming videos on technical analysis, right? So an order is an offer sent using your broker's trading platform to open or close a transaction. So if you want to sell Euro USD or you want to buy, what you're going to do is you're going to put in an order to sell or an order to buy, right? But it's essential that you know that there are different types of orders. So basically the term order refers to how you will enter or exit a trade. So there are different types of orders, right? Like categorically they can be grouped into two, right, that brokers provide. So we have a market order, which is the first order type. So a market order is an order, right, that is instantly executed against a price that your broker has provided. What this means is that let's say Euro USD is trading at 1.2000, right? And then of course there's the bid, there's the ask. So when you put in a market order, you're basically saying I want to sell, I want to buy at the present price that you, my broker, can offer me, right? While a pending order is saying that you want to open an order to be executed at a later time or at a particular price, right? So we're going to be diving deep into that in the next coming slides. So okay, sorry about that. So what is a market order? A market order is an order to buy or sell at the best available price, like I said. So for example, the bid price for Euro USD is currently at 2.2140 and the ask price is 2.2142, right? If you wanted to buy Euro USD at the market price, then it would be sold to you at the price of, remember I said if you're going to buy what, you're going to buy at the ask price, right? That's 2.142. That's this. You will click buy and your trading platform will instantly execute a buy order at that price, hopefully, right? Because they are depending on the volatility of the market, price can skip to a different place by the time it's executed. But just keep in mind that a market order is basically going to execute your buy or sell at the present price that your broker is offering you, right? So what are pending orders? So a pending order refers to an instruction given by a trader to a broker to execute a trade at a specific price level in the future under certain conditions, right? So unlike a market order, which is executed immediately at the current market price, a pending order allows traders to specify the entry price at which they want the trade to be triggered. So let's do something here. Assuming, okay, I think I have an illustration for that. So first of all, pending orders are of two categories. We have limit entry orders, and limit entry orders is of two types: buy limit and sell limit, of course, if you want to buy or sell. Stop entry orders are of two types as well: buy stop and sell stop. So I'm going to be explaining these concepts in a few seconds. So in case you're confused, just be patient. So for buy limit, this is what it means. Assuming this blue right here is the current market price, let's say 1.2000, right? And you want to buy, but you have a feeling the market is going to go lower first before it goes higher. So you want to buy, right? But you don't want to buy at this 1.200. Let's say you want to buy at 1.1, right? Let's say 500, right? So you don't want to buy at 1.2000. You have a feeling the market is going to go lower before it goes higher. So that's what the buy limit does, right? While a sell limit, the order is placed above, right, above the price. And then, so if blue is in the same vein, right, if this is where we are, but you don't want to sell at this particular market price, you have a feeling that the market is going to go higher before it goes lower, so you set a sell limit at a particular place in the market. So limit order is an order placed to either buy below the market or sell above the market at a certain price, right? So you place a buy limit order to buy at or below a specified level, right? So below a specified level, below this particular market price, or you place a sell limit order to sell at a specified price or better, right? So once the market reaches the limit price, the order is triggered and executed at the limit price. So you use this type of entry order when you believe the price will reverse upon hitting the price you specified. As you can see, a limit order can only be executed when the price becomes more favorable for you. So 1.200 is not favorable for you, so you wait for it to go lower before you buy. Or let's say 1000 is not favorable for you, you don't want to sell at this particular place. Let's say you've analyzed that price is going to go a little bit higher first, so you now want to sell at, let's say, 1.1500. Right? So that's the entire concept behind the limit order, right? Alright, so up next, what is a stop entry order? A stop order, right, stops an order from executing until the price reaches the price that you choose. So you would use a stop order when you want to buy only after price reaches or rises to the stop price, or sell only after the price falls to the stop price. So a stop entry order is an order placed to buy above the market or sell below the market at a certain price. So this is what it means. If in the previous example we said you want to buy, but you think price will go lower first, so that's where you're putting your limit, right? In this example, you want to buy, let's say you have a feeling that the market is going to keep rising if it goes beyond a certain point, right? So you're going to put your stop order there, because you know that if price passes through there, then it keep going higher. Or in a sell scenario, this is your market price and you have a feeling that price will start selling or keep going lower, right, if it breaks below a particular point. So that's where you put your stop order. So you place a buy stop order to buy at the price above the market price, and it is triggered when the market price touches or goes through the buy stop price. That's this. You place a sell stop order to sell when a specified price is reached. So that's it for stop orders. So that means if you were dead wrong and Euro USD, okay, so no need for that example, let's keep going forward. So stop loss and take profit are the other two concepts you need to come and understand. So let's say you already know how to open your trade, right? You can either open at market price, or you can open at using a pending order, either at limits or stop, right? So the other two things you need that are important when you're opening your trade is stop loss and take profit, right? So a stop loss is an order to close out of the market, right, if the market price reaches a specified price, which may present a loss or profit. So a stop loss order is a type of order linked to a trade for the purpose of preventing additional losses if the price goes against you. So from the name, stop loss, right? So if you are in a long position, it is a sell stop order, because what you are doing is that you are buying, right? That's long. That's the meaning of long. We've established that. So if you're buying, right, and then market instead is falling down, right, so you're trying to stop that sell, right? You're trying to stop yourself from losing any more money because the market is selling. So if you're in a long position, it's a sell stop, or if you're in a short position, it's a buy stop, because you are shorting, right? So you're selling, and so market instead is going higher, so you want to stop that buy from affecting your account. So for example, if you went long, right, or you buy euro USD at 1.2230, to limit your maximum loss, you set a stop loss at 1.2200. We've established that these are pip, right, this 4 decimal place. So we can see that the difference where you set your stop loss and the market price, the difference is 30 pips, right? So that means if you were dead wrong and euro USD drops to 1.2200, because you buy at 1.2230, which means you're expecting it to go higher to 40, 50, right, or 31, 32, but instead it drops to 1.2200 instead of moving up. So your trading platform will automatically execute a sell order at 1.2200, right, which is the best available price, and close out your position for a 30 pip loss. So if you put your stop loss at 1.2200, if price goes down instead of going up, it's going to close you out, because now you have already analyzed that if price reaches that particular point, then your trade idea is not correct. So your stop loss will now close out your trade at that particular point, and you won't have to lose any more money. Good. The next one is take profit order. So a take profit order is a type of limit order that specifies the exact price at which to close out an open position for a profit. In the previous slide, we talked about stop loss, how it will close your trade when it reaches a particular level, because that means your trade idea is wrong. While in this case, take profit order is going to close your trade at a particular level because you were right and price has already risen and you have already acquired a certain amount of profits, right? So if the price of the security does not reach the limit price, the take profit order does not get filled. So assuming this is the market price and you're expecting that price will go higher, right, up to this point. At this point, your trading platform will close out your trade, because this is where you set your take profit or TP, right? But if it never reaches here, price can do whatever it wants and it will never close out whatever profit you've made. So that's what a take profit order. Why this is your stop loss essentially. So if you're buying, expecting it to go higher, and then you take profit at this zone, but instead it goes down and the trade is going against you, when it reaches the specified level you chose, it will close you out, right? So more of these concepts will be, you understand them more when we get into the practical side of things, right? So take profit orders are orders that are closed when a specified profit level is reached. So that's essentially what I wanted to go over in today's teaching, and in the next teaching